5 stocks that the super investors have started a position in Q3. First one, Warren Buffett, Berkshire Hathaway has bought Siri, Sirius Satellite Radio. Guys, SIRI. Remember, Warren Buffett isn't necessarily always involved in these decisions, but let's take a look at Siri to start. Mo, what you got on Siri that looks interesting to you?
Oh, let's see here. I like that their cash flow is higher than their net income.
Okay.
Let's see.
Definitely the 5-year number.
I like their gross profit margin, almost 50%.
Yeah, it's really good.
Wow, look at that return on invested capital.
Very large.
40.7% over the last 5 years, 51% over the last 12 months.
It's a reasonable amount of debt. So look at the market cap, 18.3 billion, 31 billion. That difference is the debt. That's kind of a lot. That's
I wonder what that could be. It's not like it's retail.
Yeah, I mean, look at that's going to be a bad on the pillar. Yeah, it's one of the X's on the pillars.
Yeah, they pay a very small dividend, very affordable dividend.
Earnings per share is expected to go from 31 cents a share this year to 59 cents a share. Pretty decent growth.
They're buying back a lot of shares.
Revenue, that's probably why they like it.
Yep.
Buying back a lot of theoretically cheap shares.
Right.
The 5-year price of free cash flow is 12, 14 on the, okay. Listen, what's your take on this? Like, I look at this going, I mean, the revenue growth is not there.
It's like nothing, basically. Even estimates are nothing.
But you look at, I own HPQ.
Yeah.
And their revenue growth is crap. Mm-hmm. But I like how cheap they are. They're much cheaper than Sirius XM Holdings.
If you just have, even if you have declining revenue, as long as they're buying back shares, and it doesn't need to crush it over a 5-10 year period.
Yeah. As long as they're able to, as long as you're willing to buy, as long as you're able to buy it at a cheap price, if they buy back shares, that's only helping you as an investor.
Yeah.
The key part, though, is at a cheap price.
Right.
Okay. Second company, Michael Burry of the famous Big Short, buying Booking.com, or what you call it, Mo?
Booking.yeah.
BKNG. Let's look it up right here.
Again, really good free cash flow versus net income.
Boy, look at that share price, $33.68.
Yeah.
10 years ago, it was $11.50. Wow.
So the return on invested capital is non-existent. I wonder.
Okay, that's weird.
What we're seeing there.
Same amount of debt as Sirius Satellite Radio.
Gross profit margin 100%.
So price to free cash flow is much higher. So their free cash flow on both the 1 year and the 5 year is much higher than their net income over 1 year and 5 year. Guys, usually companies have it flipped, and that always concerns us. This one, they actually have a higher free cash flow than net income. They're probably depreciating a lot of their previous investment. Is probably the reason why. Gross margin, 100%. Sick. Profit margin is up a lot. Is there a reason why?
So their cash flow is really high compared to other years.
Mo, look at this revenue stuff. 8 billion, 9 billion, 10 billion, 12 billion, 14, 15, 9, 16, 20. This is obviously COVID driven, I'd imagine.
Yeah.
But big time.
They made $1.2 billion in acquisitions in 2022, but
analyst estimates, not that we care about that. Oh my God, big time growth in earnings per share, Mo. 148 to 246 in the next 4 years. Revenue growing
pretty good.
High single digits. Yeah. Let's do a stock analyzer on this one. What do you think? Why don't you give me your assumptions? Now remember, guys, if you're new to the channel, we use our stock analyzer tool to make assumptions about the future, purely based on income, revenue, profit, that's it, no balance sheet. I'm going to do a 10-year analysis here. So Mo, give me low, middle, and high revenue growth numbers for Booking.com.
How about 4, 7, and 10?
4, 7, 10. Profit margin.
20, 22, and 24.
Okay.
Free cash flow got to go higher.
Of course, much higher, because look at their free cash flow over the last 10 years, 30.8%. Significant. Every single level is significantly higher than its profit margin.
How about 27, 30, and 33?
27, 30, 33. I like it. Now, PE and price to free cash flow in 10 years.
13, 15, 17?
Okay, so why'd you go 13? Why'd you start at 13 and not start at 15? And I'm not saying it's wrong, or I think I disagree. Why'd you start there?
It's not a business where you have, there's a lot of these guys out there. I don't know how much they can grow. I don't know how, first of all, 17 on the high side, I think that's plenty high. Don't you think?
Yeah, I think so.
So coming down, I almost said, okay, where can they be on the low end with those assumptions of 4% revenue growth with 20% margins?
So I agree. I think to myself, if they're not growing a ton, and I sit there and say it's probably a company that's going to get anti-sentiment against it. So I want to be more conservative.
Especially if travel takes a hit.
Yeah, but in 10 years though, I don't
true.
know.
Yeah.
All right, what about your desired return? Now, guys, remember, this is your margin of safety, and I think I'm going to have a different opinion than you.
So I'd put in 12,
Oh, I actually agree.
14, and 16.
Yeah. So usually on big companies, guys, that I want to own, I'm starting at 10 or 9.
Yeah.
On the low side. But this is not a company that I think to myself, like, would I be surprised if 15 or 20 years from now, Booking.com was gone? I'd be like, no. As opposed to Nike, I'd be absolutely floored.
Right.
So I need to have a higher return for that margin of safety. Let's hit the analyze button. Stock's currently at 33.70. Remember, guys, we're about to do 3 more stocks, so stick with us. Oh, boy.
Oh, geez.
Okay. So if you buy at today's price, the middle assumptions occur, you'll make 9.75%. This all includes dividends if they ever pay one. High side, 15.3, low side, 4%. So to me, I just look at it going, if I want to own this company, I just got to wait a little bit.
Yep.
All right, Ray Dalio, AVGO, Broadcom.
Let's see what Dalio sees.
Oh, I like this now. Do you see our stock search? When you put a stock in, it also pulls up the news articles. Look at Tim. I love it. Nice job, Tim. Decent return on invested capital over the last 5 years of 13%.
Yeah.
22% in the last year. Man, this price to free cash flow just seems high in PE. The price to free cash flow is lower, higher free cash flow, higher 5-year versus the net income. But boy, and they're taking half their money, $7.6 billion and spending on dividends. Boy, look at these margins though. But this is the chip industry. Oh man, is there any reason why Dalio likes this? Do we know why? This company is a 20 bagger in the last 10 years.
Let's see what the pillars look like. Okay, not bad.
Not terrible, because the shares outstanding, 4%. It's an expensive company. I don't blame them. I still don't like it. According to analysts, EPS growth of mid to high single digits. Actually, high single digits. Revenue growth, mid to high single digits. All right. Like, to me, I don't even need to put it in the stock analyzer tool. I just look at this and think, this is an industry that has a lot of up and down. They have a lot of fluctuations. Had they been really benefited recently from the recent surge in all these chips and all that stuff, I would for me, I'm just, I don't know.
I don't remember the last time I did this. I have no idea. It's on my watch list price for $350. So I don't know what
You probably put it in a long time ago.
Yeah.
All right. I do not have it on my watch list at all. Okay.
All right.
Ron Barron. Now, guys, I want to explain to you if you don't know who Ron Barron is. He is probably the biggest Tesla bull out there. So frankly, guys, and this is me being biased, and some people out there, just like when they said, when we were criticizing Kathy Wood when ARK Investments was at $150 a share, and I said, she doesn't know what she's doing. Well, she has a fund and you don't. Okay, now it's down 70%. Sweet. I have a hard time taking somebody seriously when they really think Tesla is the next big company, the justifiable in today. He said, all these things, I look at it going, and that's my bias, completely my bias. I get it. So take that for what you want. SentinelOne is his newest pick. It's a cloud-based cybersecurity company specializing in endpoint protection. $7.5 billion market cap. Look at that enterprise value.
Yeah.
So guys, a lower enterprise value than market cap, that's a great balance sheet. It means they have more cash than debt. It's hard for a business like that to go under. And guess what? They need that because they don't make money.
Everything else here looks rough.
Yeah.
Just from a very surface level.
So it seems like he's the kind of guy who's wanting to make an investment in something that he thinks has a lot of future potential. Should I call him Kathy Wood Jr.?
That's revenue growth.
Yeah, so he's probably banking on major revenue growth. By the way, guys, a company can still lose money and still be a good investment if the revenue growth, how are they diluting shareholders? Are they?
Yeah. In 2020, they had 215 million shares outstanding. Right now, 297 million.
So guys, what they're saying to Mr. Barron is, hey, Mr. Barron, thank you for investing in us, and we're going to dilute you every single year. And he might have factored that into his investment analysis. I don't know. But you have a company, for me, my personal opinion, this is the way it makes sense to me, and Mo as well. We like to bank on companies that are established, that have a little bit of negative market sentiment because they're old and, oh my God, this company is so big, how are they going to grow? So people misprice it. This is the kind of company that has a lot of growth potential, but they're also diluting shareholders. They're also not making money. And there's only 2 ways to cover losses. You either issue debt or you issue shares. That's how you cover losses in a company. Yeah. Either way, you're making the balance sheet worse, or you're making the investor who makes who banks on them today, you're telling them, hey, we're going to dilute you as an owner, right? So what that means is if there are 10 shares outstanding, you own one, and they add 5 more shares, you still own 1 share, but instead of owning 1 of 10 shares, 10%, you own 1 of 15 shares, 6.6%. You got diluted by 1/3.
Yep.
Guys, we're about to look at Mohnish Pabrai, but before we go there, if you're interested in the software, you want to be a friend of the channel and join our community, go to everythingmoney.com. There's a free, full access 7-day trial because, guys, I don't need you to make a decision right now, but I want you to make an informed decision. So go to Everything Money, sign up for the 7-day free trial. You get full access to our community and all the tools you've seen here for a full 7 days for free. Let's go check out Mohnish's new pick. ARC Resources, producer of metallurgical and coking coal. The company sells its coal to power plants, steel mills, and industrial facilities. Interesting. Okay.
Majority of its revenue is derived from Asia.
So one red flag for me, free cash flow is a lot lower than net income. But the good news is, Mo, it's still at a low price of free cash flow.
Right.
6 to 10. Okay.
It's a healthy dividend.
Oh my gosh. Is that dividend for real?
Yeah.
Wow. Why are they paying a dividend?
They are buying back their shares.
Are they?
Yeah.
Okay. 21 million shares outstanding. But Mo, they just surged here.
They did surge. What was this? Oh,
did they make an acquisition?
Acquisitions or something?
So we just saw a big jump
I've seen
from
jumps.
1 year to the next on.
Not really.
No. And sometimes what that would be is an acquisition. And we'll say to somebody, hey, we're going to give you shares. But even then, why are you giving cheap shares to a company when you buy them? Give them cash. Don't give them your cheap shares. If you're an expensive company, give them your shares. Like, okay, here's some shares because we're too expensive. So we pay you, if our stock is double the price it should be, we're basically paying half for the company than we're giving you.
Yeah.
Look at this revenue. Minus, minus, minus. All right, let's run this in Stock Analyzer tool real quick. I'm gonna go -6, -3, 0. Profit margin, I'm gonna go 10, 13, and 16. Free cash flow, oh boy, 8, 10, and 12. PE, 8, 10, and 12. 8, 10, and 12. And desired return, 13, 16, 19. Guys, I basically put this in here like, okay, I do not want to own this company. I'm going to butcher everything. And if it still comes out green, I might take a look. But Mohnish is much better at finding real diamonds in the rough. He has that ability.
He goes deep, deep, deep.
He goes deep. Hit the analyze button. Actually, it's not terrible. Guys, thank you very much. 5 super investors and their purchases last quarter.